Good morning and welcome to T-Hub Capital, the Investors Lounge, the podcast where we explore financial market dynamics, emerging trends, and the insights that shape successful investments. Each week, we'll delve into the strategies and analyses that drive our investment decisions. You'll get an insider's perspective on the factors influencing markets and the potential winners and losers of tomorrow. Subscribe to the podcast to stay ahead of the curve and make informed investment choices. Enjoy listening.
Welcome to T-Hub Capital's The Investors Lounge Weekly Podcast. Today's date is the 9th of December. Let's dive into the week's top market news. European markets. Balancing rate optimism with macroeconomic resilience. The Pan-European Stocks Europe 600 index closed in positive territory last week, rising 0.41% in local currency terms, driven primarily by renewed hopes for interest rate cuts in both the United States and the United Kingdom. However, major continental indices displayed mixed trends. Germany's DAX led the gains with an increase of 0.80%, followed by Italy's FTSE MIB, which posted a slight advance of 0.17%. Conversely, France's CAC 40 closed modestly lower, while the UK's FTSE 100 underperformed, ending the session with a decline of 0.55%. On the Eurozone macroeconomic front, the data presents a complex picture characterized by a slight pickup in inflation and economic growth exceeding expectations. The preliminary estimate for annual headline inflation rose to 2.2% in November, up from 2.1% in October, a figure slightly above economists' forecasts but still close to the European Central Bank's 2% target. Rising services costs were partially mitigated by falling energy prices, while core inflation, excluding volatile food and energy components, remained stable at 2.4%. In parallel, Euro area gross domestic product grew by 0.3% in the third quarter, an upward revision from the previous estimate of 0.2%, supported by a rebound in fixed investment. France and Spain drove this expansion, compensating for the stagnation of the German economy. The labor market remains solid with the unemployment rate stable at 6.4%, while retail sales marked a 1.5% annual growth, surpassing analyst estimates. Despite the GDP stagnation, German industry showed unexpected signs of vitality. German factory orders rose 1.5% sequentially in October, marking the second consecutive monthly increase and clearly beating the consensus forecast of 0.5% growth. This result was driven by a substantial increase in orders for aircraft, ships, trains, and military vehicles, accompanied by an 11.9% rise in metal production and processing. In the United Kingdom, the housing market demonstrated notable resilience despite fiscal uncertainties regarding the autumn budget and stamp duty changes. The nationwide Building Society's House Price Index rose 0.3% sequentially in November, defying forecasts of zero growth and accelerating from plus 0.2% in October. Bank of England data confirms that underlying mortgage demand remains solid, with net approvals for house purchases dipping only slightly in October to settle at 65,018 units. Now our insight into alternative markets. The secondary market in private equity, from liquidity niche to strategic pillar. In the current private capital landscape, few areas have undergone such a radical evolution as the secondary market. What was once considered merely an emergency exit mechanism for distressed investors has transformed into a sophisticated tool for active portfolio management. In an environment characterized by tighter fundraising conditions and increasing competition, secondaries today represent a crucial strategic lever for both limited partners, LPs, and general partners, GPS. To truly understand the strategic value of this market, it is fundamental to distinguish between the two main types of transactions that define the process, starting with the traditional form known as LP-led secondaries or investor-led transactions. In this scenario, a limited partner, such as a pension fund or family office, sells their stake in an existing private equity fund to a secondary buyer. The selling LP offers their interest in the fund, prompting the buyer to evaluate the underlying portfolio, which is often composed of mature companies, and propose a price. This price can be set at a discount, at par, or more rarely at a premium to the net asset value, NAV. The advantage here is twofold. The seller obtains immediate liquidity and capital reallocation, while the buyer benefits from J-curve mitigation by entering when the fund is already generating returns and gains immediate visibility on the assets. While LP-led transactions represent the market's foundation, the area of greatest recent innovation is found in GP-led secondaries, or manager-led transactions. Here, the fund manager orchestrates the transaction, often by moving one or more trophy assets from an expiring fund into a new vehicle known as a continuation fund. The GP identifies high-potential assets that require more time or capital to maximize value and offers existing LPs two distinct options. They can either cash out by selling their stake or roll the stake into the new fund to continue participating in the growth. This mechanism allows the GP to retain their best assets, adhering to the philosophy of not selling winners too soon, while LPs gain a vital liquidity option in a blocked exit market where IPOs and M&A activity remains sluggish. Looking at the market context for late 2024 and 2025, the latest data confirms that the secondary market is not only resilient but thriving precisely. The year 2024 closed with estimated global volumes exceeding $160 billion, a historic record that surpasses even the peaks of 2021. Europe has played a key role in this growth, witnessing a significant increase in activity, particularly in the UK and Northern Europe. A major driver of this activity is the denominator effect, where many institutional investors found themselves overexposed to private equity due to the decline in public market valuations. This imbalance forced strategic sales on the secondary market to rebalance portfolios, subsequently creating a steady flow of high-quality opportunities for buyers. Furthermore, a clear sign of market maturity is the reduction of the bid-ask spread. On high-quality buyout funds, transactions are currently closing with single-digit discounts, often trading above 90% of NAV, which indicates strong buyer confidence in the underlying assets. In Europe specifically, continuation funds have become the norm for mid-market managers wanting to retain performing assets. With the IPO market still timid and industrial exits complex, secondaries have effectively become the primary route to generate the distributions, DPI, that investors demand before committing to new funds. For firms like T-Hub Capital, attention to the secondary market is no longer optional. In a challenging fundraising environment, the ability to utilize secondaries to generate early liquidity or to access quality assets at correct valuations represents a clear competitive advantage. We are no longer talking just about buying and selling stakes, but about financial engineering applied to long-term value creation.
Thank you for listening to this episode of T-Hub Capital, the Investors Lounge podcast. I hope you found this content interesting and inspiring. If you enjoyed this episode, don't forget to subscribe to the podcast so you don't miss a single episode and share it with your friends and colleagues who might be interested. To learn more about T-Hub Capital and our activities, visit our website, thubcapital.com. You can also follow us on our LinkedIn page. See you soon. All the best from the T-Hub Capital team.